Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for the week ending Friday, March 13th, 2020. We'll take a quick look here at the broad markets. Keep it simple, just keep it on QQQ, maybe look at SPY and the futures real quick, and let you know what I expect going forward. All right, so yesterday morning, just to recap, I may keep this one just we've gone kind of dark on the public content, YouTube videos and the public content on the site because we still have an active trade on QQQ. And again, if you're not familiar, right side of the chart has a freemium model, like a lot of apps you get on your download on your iPhone or your Android, where it's a free trial. If you like it, good enough, you're going to use it, you'll buy the paid app. And so we do that. And the free content is just general stock market analysis. 99% of what we do is everything else, individual stocks, trade ideas, ETFs, gold, treasury bonds, Bitcoin, commodities, you name it. If it has a ticker, I'll trade it, whether it's corn futures or soybean or, like I said, Bitcoin. Again, we recently had and now again have a trade on LQD corporate bonds. So the QQQ and SPY are the main ETFs that I focus on the broad market. And again, since we have a active trade, we hit our first target on the QQQ short trade yesterday. We closed that out. For those that are actively trading, I stated we'd probably see a bounce in the market. The risk reward was getting very unattractive to remain short without a bounce. We're probably looking at a bounce yesterday. We closed that one out for a 14.1% profit, but it's still an active trade. So what I had said, and I'll still maintain those, I still have at least one additional target, and I'm still allowing this to have the potential to be what I call a runner trade. When we first started it, after closing out our long, we went long here, rode that long up, shorted up here, rode it down. And I'm still leaving this trade right now. We have one additional target, which I won't get to in this video, and I may add additional targets depending on what we see next week. All right, so what happened today and what happened since then? We did bounce. In fact, we bounced yesterday. Let me get to the 60-minute charts. I'll show you what we're watching. So yesterday we bounced, and we had my bounce target was right up here, shy of this, just shy of the gap right here, more of the resistance. Let me move that line down. I had it on the daily chart. This chart I screenshotted actually shows the targets, the next target on that trade, so I'm not going to pull that up right now. We had a bounce initially, pulled back, and as I stated, that's where I kind of stepped back from trading. We had a great run, and I said I was going to keep it light. I expected the market to grind around, which it did, and what I said is we're going to watch this trading range. This is since yesterday right here. This is yesterday's candle. That's Thursday morning. We gapped down, and we've been bouncing around in this range, and so what I said is the next upside break, other than you get these brief pops, but the next upside break would probably determine the direction of the trend. So that happened into the close today. There's today's candle. We traded all day. In the final few minutes, I ramped it up, which I think presented, and I'll say now, a golden shorting up because we rallied right up to that uppermost bounce target there. I'll say uppermost. There's a trend line we took out, but for the most part, and I can take that trend line like I had it before. I had it on this reaction high right here. See now? Here, let's drop everything off so you see what I'm talking about. Sometimes I see these things easily in my mind's eye, and I have so many levels right there. Off that candlestick high, that's where I had it before. So we bounced into potential trendline resistance. We pretty much had a reaction there because we stopped trading today. We haven't pulled back or consolidated there yet. And then boom, that's a big old support shelf, which we gapped down. So that was backfilled. And so as I said earlier today in the video to subscribers, trading a bear market or a correction that's impulsive like this is like swing trading normally in a bull market, but with the fast forward button on 3 to 5 times, maybe in 10 times speed. You got to be quick. You got to get in and out of these. So what happened today? We popped that later in the session. Really, I didn't bother kind of screenshot and get anything out. It happened late in the day. There was really no way to get a post out on that. It's just a level to watch. Again, that was posted earlier. And turn it back on. There was that box. So we popped above the box, ran up, And there's certainly the possibility for more because we still have on this 60-minute chart the divergence on the RSI. They took it out on the PPO right here. PPO made a higher low. There's still RSI divergence, and that RSI divergence also shows through on the daily chart. So while more upside is possible, there's just a ton of overhead resistance for this market to overcome, and I think that's probably it for the bounce. I know the Fed is doing everything they could, and that's what I said yesterday. That's one reason I said, I was covering shorts, going long for a bounce. This is the point where Washington, including our president, who absolutely is obsessed with the stock market, as we all know, is not going to lay idle as this happens. So, the Fed started out yesterday with what was 150 trillion in repo injections, and now, more liquidity. They're pumping money into the system via the bond market, quantitative easing, same stuff they were doing before, treasury repurchases, whatever's going on. Again, it's to be expected. They're not going to sit back idle while this happens, and I would not be surprised in the least, especially if this gets worse before it gets better, as I think it will, to hear about the rumblings coming out again of banning short selling and all that stuff, which, in my opinion, will be a colossal mistake. And if they happen to pull it off this time around, they talked about it during the last financial crisis, then at best it would lead to a very potentially explosive short-term pop, but it would have devastating long-term results. I don't want to get into the technicalities of it and the reasons for that, but I'm a firm believer that short selling is a critical part of the market. It helps efficiency, provide liquidity, and also helps with price discovery. Takes companies and the market down to levels where it needs to be when others might not see that. So. All right, now what happens is in a volatile market like this, you have, especially after the drop we've had and sentiment reaches extremes, and again, that's why I was talking about the risk-reward being, for the very near-term poor in the market for remaining short or going short yesterday. That's where you get these 8.5% rallies like we have today in QQQ. Shorts get squeezed, what I call the JCL shorts, Johnny-come-lately shorts. Those that didn't want to short here, they didn't want to short here on the breakdown, the divergent high. We were mentioned, being short there, covering here for the bounce, or on that very objective kickback to the 218.27 support level right there. But anybody that wanted to short yesterday with the RSI already pinned down on extreme oversold conditions, oversold levels with the market, at various support levels. So what I'm getting at is undoubtedly today a lot of shorts were squeezed out of the market. So I think the weekend was coming up. Here's what that ramp looked like into the close. And this is that trading range we've been in for the last few days here. Let me clear all lines off this chart. This is a 1-minute chart, so you just can see what's going on if you were working today and you weren't watching the markets. There's that trading range I was talking about. There's the upside break, and it all occurred in the final minutes of trading today. There's the 3 p.m. hash line right there. So this is 10-15 minutes trading before the trading day ended or so, and that's the ramp to close. But again, right into resistance. So that allowed me to reload back into some more shorts. I think that's objective. Whether we go up more or not, the fundamental picture is not getting any better. And I also said this to subscribers yesterday. Yesterday reeked to me of what I use it made-up term, a news climax. In the stock market, you have selling climaxes, which we had one recently. I talked about this in today's video for subscribers. Back here on this day when we went long that last official long trade on QQQ on the 28th, you can see we had a spike in the volume after a big drop, and let me turn the volume bars up for you right there. See the biggest volume bar in years on the 28th. That's what I call a near-term selling climax, and that's why we only wrote it up for a quick bounce, got out about right there, and then went short for the next leg down. So what yesterday was, today may have also been another near-term selling climax, but I wouldn't even put on the same scale there. These two bars were about the same. I think this was just technically induced. As I covered recently, the NASDAQ 100. This is what happened last night. I just flipped over to the NQ 60-minute chart. We had support. This is where we were yesterday when we opened up and where that target was hit on the QQQ short trade. We got out. We had initial bounce. It's so small. It happens so fast you don't see it on these 60-minute candles right here. I'm sorry, this is daily chart here, but I want to just show you the levels to watch here. So that was at 73.50, very good support level, plus you don't see it's buried there, 61.8% Fibonacci retracement from the December 24th low up to the recent highs. You can see how each of these fibs, there's a 32, we had a reaction there, your first bounce off the 32% fib plus price support, came down, here's a 50% fib, that orange line right here, had a reaction there, took that out, fell down here. We did have, again, this is a daily chart, so you're not seeing the intraday. We had a sharp bounce that morning, yesterday morning, almost to where we went to today, and then went down again. That was the initial tag of the 50% fib. And down here, a little below, we have the 74, but I have price support here that was hit at that 7,000 level there on NQ last night, and that kind of contained that pullback. And again, you have oversold conditions, and that's usually where these sharp rallies come from. And keep in mind, the longest of trend indicators are still bullish right now. Probably won't be for much longer. We'll know at the end of the month, my monthly trend indicators, but that's it. So what happened? Big reversal. However, lots of resistance. This is pretty big, very big resistance here that we rallied into today, about 8,000 give or take on NQ, and with plenty of resistance overhead. So that's how the futures look on the daily time frame. A lot of my focus has been on the NQ lately. It's more of the leading index. It's certainly led the bull market up a lot more than the S&P 500 with those, all the big FANG stocks. Here's my 60-minute chart. I haven't even touched this. I didn't even look at it before the video. There's that same trend line I had last time I updated this for subscribers here. Boom, rallied right into the downtrend line. There it is. That was that recent trading range there. Popped above it. We had that 78.15 resistance we just shot. I think this is just a momentum fueled overshoot. I think there was a lot of short covering and shorts being squeezed out before the weekend. The Fed has the markets back like they always have. So I think people are worried. I give you my thoughts. Right or wrong? Could we bounce more? Absolutely. But like I said, there's a lot of resistance levels up here, and I think the market has. I think it's going to be tough sledding on the upside. So if we do bounce, you can see my levels. They're all marked here, right there. Potential bounce targets. And let's do this. Let's throw up some Fibonacci retracements right now. Let me pause this and put up some new fib levels here. And before I do that, I'll show that was the golden op. We had, the 50% retracement here, I just want to say. And that was what I call Powell's Folly right there, the 50 basis point rate cut pipe. Hike, another failure at that level there, rate cut, I should say. And then boom. So we're in a bearish trend. And, I'm talking fast. I'm showing you a lot of levels. Everyone's going to have their own opinion on how powerful the Fed is and what they can do and not do. I'm a firm believer that the market will go to where the fundamentals say it needs to go, and that's what's going on lately. The market's trying to price in this impact of the coronavirus and what it's going to have on the economy. All these companies, canceling meetings, canceling flights, sporting events being canceled, everything, Disney World being shut, all that good stuff. But just take a step back. What we're looking at here is a clear and unmistakable downtrend. That downtrend can be broken, but a downtrend is simply defined as a security making a series of lower highs and lower lows, and that's it. There's your lower highs and lower lows, and that's all this is so far. If we take out 83.55, that's the last major reaction high right there, and that starts to call the near-term downtrend into question. Until then, we're rallied right into a downtrend line resistance. We have price resistance just above that should the futures rally on Sunday night or Monday morning or whatever, and or into the market on Monday, and that's where it doesn't completely at all, it doesn't eliminate the chance that we're not going a lot lower. It just kind of, from a technical perspective, it brings that near-term downturn into question if we take out 83.55 a lot. Up until then, this is my preferred scenario. More downside to come. Fed can do and will do what they're capable of. But this is, like I said today to subscribers at rightside of the chart.com, in all my years of trading and investing, which is quite a bit now, I have never ever seen such a rapid and pronounced shift in the fundamental landscape. Most of the time, these videos I'm talking about, the trade ideas I share, are based on technical analysis, reading the charts, looking at the charts, chart patterns, chart developments to predict where prices are going to go on a security. But I do have a background in fundamental analysis, and it doesn't take an economics major or a PhD in economics right now to realize that this coronavirus is going to is having a direct impact and a sudden impact on the market. With that being said, volatility is here to stay. The only way you're going to successfully swing trade this market down, especially if you're not an active and nimble trader, able to jump in and out of these rips and dips based on what's going on in the technicals, is to allow wide stops and, again, if you are short, looking for more downside. And if you're bullish and long, you don't have really any buy signals yet. You have a big update today, but from a technical perspective, other than that short-term buy signal that I mentioned earlier, I was the last couple of days watching these 60-minute charts right here on both QQQ and SPY. Yeah, we broke out of that, so that's a near-term buy signal, but you rallied right into resistance. So how far we go, I already shared my thoughts. Here it is on SPY. I have kind of this little smaller range within, and then the bigger spikes without, which were defined in the blue box here. And again, we popped up there, but look at SPY. Big old resistance at 273.40, and if I take this trend line, which I'll do now, and fit it to that reaction high, we have now three distinct reactions. One up here, that's the reaction high from March 4th. This candlestick right there, let me get it nice and tight. And that is the reaction high from March 10th. And boom, where we rallied today, plus resistance overhead. If they happen to pop that, then you can see we have this same box. Let me move this box right up here. Here was another area of consolidation. So it's, I hate to always say, this, but at the risk of oversimplifying it, it's this easy. You get these periods of consolidation. They can go either way. The charts will indicate, which way sometimes, but you got to respect which way. Here's one that was pointed out at the time. We broke to the downside with an impulsive gap, and that set this up. So we moved down. That was our next level. So the market's stair-stepping higher. We don't always have these boxes like this. This time around, we had a kickback rally, but that we did have, as pointed out at the time, a lot of resistance right there where we rallied back into. And again, turn off all the trend lines, keep it super simple. And that's the bigger picture says we are in a downtrend on the S&P 500. If I can get the right tool, simply zigzagging down, making a series of lower lows and lower highs until when will that start to be called into question? If and when we take out this high right there in SPY, which is at this line about 290.27. And again, you want to see what happens on QQQ as well. And if it takes it out, there's still other reaction highs along the way. And this was a big level. That's where, again, what I call Powell's folly failed, and market turned around, and then the subsequent kickback to test and failure at that level right there, about 313.46 on SPY, and that comes in around give or take 220, 218, 220 on QQQ. So those are the levels overhead. There's the divergence. Like I said, they already burned through the 60-minute PPO divergence, but the RSI divergence is still intact. RSI divergence here on QQQ is still intact as well. And when you see it from this daily chart, have fewer lines, it's not as busy. You can see these levels. There it is. We have a pretty clear level at about 194.40 or so. And that was where originally we had the first target on the QQQ trade, if I'm not mistaken. Then we lowered that target, pulled that one. But that's that big level there. We had three major reactions as QQQ tried to break above that level, and it finally was able to break out there. On the way back down, it did act as support. We had a big rally after that. We tested it for 3 days and then failed, and now we kicked back to it. So TA 101, Technical Analysis 101, says support, once broken, becomes resistance. Just like resistance back here, once broken, becomes support, which it was. Came back, we visited it. This is normal during a downtrend, especially when you're oversold. You're going to have a reaction along these. No, you don't always have to. You could have gap down below it immediately, but it's not what happened. We had 3 days of testing that level, then a gap down below it on the 4th day, and now we've kicked back to it. So it's again, at the risk of oversimplifying it, that's kind of what's happened, and those are the levels to watch. I maybe could move that line up right there to that reaction high, but so we'll see where we go next week. And let me just speak to the long-term trend indicators. Monthly, as much as I think that this is probably it this time around. I've thought that before. I thought we would probably go on to break our monthly trend lines and get some sell signals back in 2018 right here it was. But we didn't, and so that kept the trend bullish. And what I'm referring to, this is one of the most simple trend indicators that I use on the longest term time frame that I've tracked, the monthly charts. So you have a monthly chart. Every candlestick is 1 month. And we're not going to finalize. We're not going to have any new signals on this chart until the end of the month, because it doesn't matter how low we go intra-month. All that matters when trading on the monthly time frame is how the monthly candles close. And so it's not that skinny part, which is the candlestick shadow, or when it's below you call it a tail, when it's above you call it a wick. The shadow is what's happening intra-month. So how you close the month is all that matters. So there's 2 levels to me that will most likely indicate a new bear market started. That's that 20-month exponential moving average, which we're still above. And look, that today's rally snapped us back above there. It also snapped us back up above the trend line. So like I said, as of now, that trend indicator is still on, or this trend, the monthly trend, is still bullish. It's still saying QQQ is in a bull market, despite the 27% drop in QQQ. I've spoke to that. That's semantics. That's the old definition of a drop of 20% or more. Times have changed. This was, I use the term supersized for this bull market, biggest bull run, longest bull run in history, and the corrections within it. Again, you can say we're in a bear market, and I think we are. I think we're going to go down more. Don't get me wrong, but as of now, when you look at this, forget about that 20% definition. You have to say this is still a bull market. That's a bull trend. We've had bigger corrections back here before than what we've had so far. I think that drop, we're close to it. That drop back there on the Qs from highs to low was about 27. Okay, sorry, I had to quiet the family dog there. Let's see, that was, remember the Qs had a little flash crash there, so they dropped more than the NDX, but that was about 27% as well, and there was about a 23% drop. But you can see here's that green candle close back above, and again, it's just done a great job. So you have right now that trend indicator, until it's taken out, it's not, and that's what we'll watch. But here's the thing: if you wait for that to trigger, if you're swing trading, that's more of your 401k long-term stuff to help to identify the trend. Once you get under that, the 20-month acts as a resistance when back tested from below during a bear market, so that can help you look for areas to add short exposure. But it's not an active trading. You don't actively trade off the monthly time frames. We'll look at the weeklies here. Here's QQQ closed right on. Again, these are those major reactions right here back from 2019, and we closed right on them with a big doji candlestick. A doji candle is an indecision candle, at least the way where it is right there on the weekly chart. All right, we could talk over and over about this stuff, but I've showed you the levels to watch. I told you I believe there's more downside, but I showed you the levels that will start chipping that case away and open the door for more upside if and when they're taken out. And like I said, when the trend is, once we're in established, the intermediate term trend is clearly bearish. The basic TA rules apply. TA 101 says you either, during a downtrend, you short bounces back into resistance, just like during an uptrend, when the market's in an uptrend, you buy pullbacks to support. So that's it. There's not much else really that stands out to me. Still watching things like the corporate bond market, which we've had we just closed out yesterday an active trade on that for very nice, up over a 22% beta adjusted gain. Sidestepped it, the bounce. by closing that trade out at the final target and then re-entered that today. That has broken, and that plays into my analysis. And I'm not going to get into it now because we have an active trade, plus that's outside the scope of broad market coverage, but I've warned, actually others have been warning too for a long time. I wasn't the first one to recognize there was a potential time bomb in the corporate bond market, and that is the massive issuance of triple B debt, which is at the bottom of investment grade. Anything below triple B rated, you go down to double B, it's junk rated. And so I'm doing this for the YouTube channel. Subscribers already know my thoughts on that. So while many for years have warned of this and warned of an implosion, we nailed the timing on it and got into that trade right before the bottom fell out of LQD, which is the investment grade corporate bond ETF. It's had a huge breakdown, clearly bearish on the technicals, and it's, I believe, going to have larger, longer lasting implications on the financial market, and it confirms that this is different from 2018 right now. There's a lot different from that drop in 2018 or any other corrections that we've seen in this bull market since it started in March of 2009. We are seeing, like I said, the most rapid shift in the fundamental outlook for the economy, with business after business after business shutting down, sporting events, not just in the U.S. either. This is not a U.S. thing, around the world. And so, yeah, on one hand, the markets fell about 27% so far, so you can look at it from just a valuation perspective. Okay, ready? All right, we shut down, let's say, and we're down for a while, and then things pick back up and we get back to business as normal. Is it going to have more than a 27% on average impact on corporate earnings and profitability? I can't answer that question now. If you think it's over, the worst is over, then yeah, maybe yes. And maybe you step in here and buy this dip, and maybe these long-term trend indicators stay bullish and the bull market continues. But the rate things are going right now doesn't look that way. And again, the breakdown, I don't just look, although the public videos just focus on the stock market, there's so many more interworking parts of the financial markets and the credit markets. Remember, the bond markets are larger than the stock market. There's more money in the bond market than in the stock market, and there's all different types of bonds. The ones I'm focused now are those investment grade corporates who have broken. The charts have broken that confirmed that, and there's a trickle down effect. That lower tranche, that historically large, unprecedented issuance in recent years of AAA rated debt at the bottom end of investment grade will be downgraded. It's almost a certainty that a lot of that will be downgraded. Not all of it, but a lot of those bonds will be downgraded to junk status, and therefore there's going to be just a collapse of the bids as those bonds must be sold by prospectus. LQD cannot hold junk bonds. It is a corporate investment grade corporate bond ETF, and there are dozens, if not hundreds, of mutual funds out there that you pick up that little thing you get in the mail when you buy it, or your broker hands it to you, called a prospectus, that governs what that fund manager can and cannot invest in. So if I run the XYZ corporate bond fund, and in prospectus it tells me that I can only invest into maybe treasuries and or investment grade corporates, or just solely investment grade corporates, that I cannot hold junk bonds, or I can maybe only hold 5%. That allows, if some are downgraded, I can hold them for a little while, but if I exceed that threshold, I have to sell them. And so you've got trillions of dollars of bonds will be, have already probably started to be, and will be sold. I know I'm not the only one that knows this. It's been well written about on the web. Fund managers know this, so they're trying to get out in front of it. That's what that recent crash in LQD was, and so I think that will continue to have ripple effects as more and more bonds are downgraded, and more managers will probably use this recent bounce that we got today with the reprieve in the stock market to get out of those lower grade triple B bonds before they are downgraded, and they must be sold. Now, what changes all that, and kind of changes the trajectory on that doom and gloom scenario I'm talking about? Well, it would be a pretty quick abatement of all these fears with the coronavirus, whether the virus remains, whether there's a vaccine or not. Maybe people just stop caring and they go back to work, planes start flying, basketball games start getting played again, things like that, and sure, the economy could pick back up, and if and when that happens, I'll try to adjust accordingly. But as of now, as I've stated recently, my fundamental outlook on the economy, much more so than ever, is having an impact, an impact on my technical analysis. So I'm looking at the charts and deciding which potentially bullish technical setups or developments to to ignore or put a lower weighting on because of the fundamentals. So like I said, the bounce that we had today since yesterday we're seeing at least the risk of staying short, and the probability of a bounce was pretty high because of the extreme oversold conditions and everything else. So I'm going to wrap it up here with the last thing that I showed subscribers today. And that is the VIX. That's not the VIX there. That's VIX C10. So the VIX here is at levels that haven't been seen since the last financial crisis. Let's just park all these away and just take a look at the VIX here, pure price. And that's it. So about this 50-ish level right here. What you're looking at, you can see the years. You might not be able to make them out in the video. This is the 90s right here, mid-90s, 2000. And all this and this is about the extreme of the VIX. The only other time it's really popped above this 51-ish level, again, it's not a hard line, is back here at the financial crisis. That was 2008. And we're close to that level now. So what is this? What does that all mean to the stock market? The VIX is a measure of put calling versus call buying. And when it's very low, you have a lot more people buying calls than puts because they're bullish. They think the market's going up. And when it gets very high, you have a lot more put buying. And what that does, it effectively puts a floor in the stock market, at least a near-term floor. Now, again, I have to warn you, it's not a hard line. There's nothing that says the VIX can't go up. There's nothing that says it cannot exceed that 2008 peak, because there is no ceiling. It's not bounded by any particular number, but you can see clearly it has a range, a low-end range and a high-end range. And so the reason for that high-end range is when there's excessive put buying, just like excessive short selling in the market, it tends to put a floor because you get that near-term capitulation. Everybody's bearish. The commercials have to hedge up. Those that are selling the puts have to hedge up because they've sold puts to the retails and to other hedge funds, institutions, and that at least near-term puts a floor in the market. And what's interesting to note, you have a subscriber on the site today. He or she said they've held TVIX for huge gains. They're still in it, and it's way up there now. And what I pointed out to them is that, look, here's the VIX right here. It peaked back on right here the week of October 24th, 2008. Well, guess what? The market plunged from there. That wasn't the top. I mean, didn't immediately. It did down into the March 2009 lows. So again, that was October 24th. Let's look at the stock market back then. Turn off all these lines. And so here we go. Let's find the week of October 24th for you and show you what happened. Let's zoom in a little tighter. And here we go. October 24th. Boom, grab that candle. That was right here. So there was the when the VIX bottomed, and from that point I'd have to grab the weekly candle closed on we'd probably been at the bottom of that candle right there, the close of it. And so you had another, just keep in mind, 23% downside in the market over a period of 4.6 months it took before the market actually bottomed. And yet had you held on to your VIX shorts, whether TVIX wasn't around back then, so I can't look at it. It started trading after. Again, the VIX plummeted from there. So what I'm trying to get at is the market can still drop, but the upside potential on VIX long trades right now is limited. Again, not to say that they can't go up, but you're at that point. And of course, we did have a nice kickback rally back at that point in the here in October into that November. There's that big rally we had, bear market rally, and from the lows to highs. Never underestimate how far a bear market rally can go. That was about 27% right there. But when you look at where we're at now, just going back, if you're of the mindset that what's going on now with coronavirus will most likely put us, well, technically it has put us into the next bear market. Just put things in perspective. Look at the last bear market, and if you do that little we are here thing, like in the mall when you see the map, you know, it seems to me like we're right here. This is just the initial drop right now. We haven't even had a decent, multi-week counter trend bounce yet. So, and this one's starting off with much more of a bang than that one. And so, again, try to put things into perspective. And the takeaway from this, if you're not a very active trader, you're not very nimble, haven't been doing this a long time, you need to take the bigger picture here and decide how you want to position, whether you want to use these bounces to maybe get out of your longs or lighten up a little bit if you are trapped in your 401k or any long positions, because as of now, and that all can change, as I said, the near-term trend at this point in time and intermediate-term trend is still bearish. So you might want to, just like a bull market in reverse where you buy dips on pullbacks to support, you might want to look to either unload some longs or add short exposure on bounces back into resistance until and unless the technical posture starts to change, and as well as the fundamentals. But the technicals are going to tell you that first. Usually they're going to lead the fundamentals in most cases. All right, I'm going to wrap it up here and get this out to you guys. Have a great weekend. This has been Randy Finney with Right Side of the Chart.